Hello and welcome to week 5. We're going to do chapter 6. So this video is just going to be going through our chapter 6 lecture notes. So I hope you're doing okay. It's officially halftime. We've made it halfway through fund accounting. So we have 4 more weeks left. And so I want to make sure everybody's doing all right and everything's feeling okay. So your discussion board this week is going to kind of check in on you like that. So chapter 6 is about the debt service fund. And so we've gone through the general fund. We did a little bit with the permanent fund. We did the capital projects fund, special revenue fund. So this is the last of our governmental funds. So the debt service fund is exactly what it says. It's to service the debt. So it's long-term debt when we have to make payments on it. There's also some general conversation on general long-term liabilities and how we account for those at the government-wide level, but not at the fund level. So there's some information on just some definitional stuff, like what is what is direct debt versus overlapping debt and things like that. The debt limit is the maximum amount that we can borrow and things like that. So you guys can kind of go through those things on your own in the chapter, but I want to get to the journal entries. So talking about debt service funds specifically, again, this is one of the governmental funds. So we are going to be setting aside money to repay, like make interest payments on debt. So it could be like a bond or something like that usually. So there's serial bonds and term bonds. The way I remember this, the way I taught you guys in intermediate, for those of you that had me, was serial bonds have several staggering due dates, meaning that instead of all of the bonds being due at one time, so maybe I should review. Maybe I should review what is a bond. And so we do this in class a lot. So when we talk about bonds, what we're referring to is I, the government, need money. And so if I need money, then I can go get a loan or I can charge, for revenue type stuff. And so in a business, I could get stockholders. But if I want to finance my business or my government through bonds, then what happens is each bondholder gives me $1,000. And then let's say it's a 5-year, 8% bond, paying interest semi-annually. So I'll repeat that. 5-year, 8% bond, paying interest semi-annually. 8% of $1,000 is $80, but it's semi-annual. So I'm going to give $40 every 6 months. So every 6 months, I'll mail you a check for $40, $40, $40, $40. At the end of the 5 years, I'll give you your $1,000 back. So that's how a bond works. So a serial bond, instead of all of the bonds being 5-year bonds, maybe some will be 4-year bonds and some will be 7-year bonds and some will be 10-year bonds, so that we pay people off sporadically so we don't have to come up with the big lump sum. So if we're issuing $1 million worth of bonds, we don't have to come up with $1 million on one day at the end of year 5. So principal matures in annual installments. For regular serial bonds, we're going to be bringing in money to be able to pay for the balance as we go. We don't have to have a sinking fund here. A sinking fund is like a savings account we use to repay the bonds. And so we're going to learn how to keep track of a sinking fund in this chapter. So term bonds all have one due date. And usually it requires a sinking fund where, because they're all due in 5 years, we need to put away some money every year to build toward being able to repay the bond. All right, so as far as debt service funds, we're going to use the modified accrual basis with one exception. It says expenditures for interest and principal are generally recognized in the period in which they are legally due. So if the interest payment is due on January 1, then that's when we're going to record that expenditure. So we don't usually need to do budgetary accounting, or we do budgetary accounting for it, except for we don't need encumbrances. So we do budgetary accounting doing estimated revenues and appropriations, but we don't have to do encumbrances because we're not buying goods and services. So it's not like people are going to double use the money. So for serial bonds, a lot of times we'll bring in like an interfund transfer to be able to pay for the interest payments. Also, like in a term bond, you're going to be earning interest because you're going to be making deposits into a sinking fund. So the financial statements will have basically the equivalent of an income statement and a balance sheet. And so remember, this one's like an income statement with a statement of equity attached to it, like to change the changes in fund balance, and then a balance sheet. Again, no cash flow. So finally, in the next chapter, we get to do some cash flow, which I'm excited about. Maybe you're not. So let's go ahead and let's do our first example of this. And so assume bonds are issued on January 1, 2008 and pay interest semi-annually on January 1 and July 1 in the amount of $100,000. The fiscal year end is 12/31/08. What amount of expenditures would we recognize in fiscal year 2008? Okay, so it says that the interest is due on January 1 and July 1. So it's just going to be one interest payment because only one payment is made on July 1, but we don't make another payment until January 1 of 2009. So it would just be one interest payment. So the answer to that is just 100,000. Okay, so now I'm ready to do some journal entries. And so am I going to run into the same issue? Oh, I am. Darn it, I need to pay more attention. Okay, but I'll fix that before I post it for you guys. So, all right, a certain city, like I can't even name the city now. That's how uncreative I'm becoming. A certain city issued $100,000 of 6% serial general obligation bonds on December 1, 2007. Interest on the general obligation bonds is $3,000 due on June 1 and December 1, and in decreasing amounts every June 1 and December 1 for the next 19 years after that. The first principal maturity of $5,000 is due on December 1, 2008. So we're going to pay off this $100,000. Let's just kind of unpack what happened here. We're going to pay off this $100,000 over a 20-year period. So $5,000 every year is going to be paid down on the principal, and then we'll only owe 95, and then we'll owe 90, and then we'll owe 85. And so in the first year, the interest on 100,000. Oh, excuse me, sorry. It's 6% is $6,000, and so we'll make a payment of 3,000 and 3,000, but then we're going to pay off 5. So the next year the interest will be less. So it says in decreasing amounts every year after that for 19 years. So let's first go ahead and let's just borrow, or we're going to go ahead and issue the bonds. Now, it didn't say, so I'm assuming I'm issuing them at face value. At face value means no discount and no premium. So that means that we're gonna receive exactly $100,000. So let's go back here, make sure I'm okay. All right, so I'm gonna receive cash. And we'll do serial bonds payable. I don't know that the word serial is that important, but it's fine. All right, so that's us. By the way, that's at the government-wide level because I don't know that we haven't done it at the debt service fund level yet. So this is the entry we're doing at government-wide. So let's take a look and see what we would actually do at the fund level, because the debt service fund isn't going to get this $100,000. It's going to be used for whatever project. So maybe the capital projects fund or something like that is actually going to receive the money. So notice that no money has been deposited into our debt service fund. So if you are the manager of the debt service fund, then you don't do a lot. So you probably have other jobs because what you're going to do is you're going to receive transfers and then you're going to pay down the debt. You're going to service the debt. So the budget approves for fiscal year 2008 in our first year to transfer $11,000. General fund is going to transfer us $11,000 for debt service, which includes a principal payment of 5 and 2 interest payments of 3 and 3. So we're going to receive $11,000 at some point during the year. So because we know that, we're going to go ahead and do our budgetary entries. So when we do our budgetary entries, we are going to record those as estimated. Normally it would be estimated revenue, but we're going to do estimated OFS because it's going to be an interfund transfer in. And then we're also going to have appropriations of exactly 11. Okay, so I have a couple different things going on here, but this is the budgetary entry. So the budgetary entry is just showing that I'm going to bring in 11 and I'm going to spend 11. So notice that our payments are on June 1 and December 1. So they are both going to happen during 2008. So let's see, a certain issues the bonds on December 1. Okay, so then they got issued on December 1 of 2007. So that's when this entry would be done. So just so that we notice 12/1 of 07 is when that happened. And then for 2008, we're going to bring in 11. And so what we're going to do is we're going to record due from general fund to show that eventually we're going to receive that money from the general fund. And then we'll call that OFS. interfund transfer in. Now, keep in mind that the general fund would do the exact opposite of this. And so I didn't note that, but like if we were doing the general fund entries, then we would call that an OFU, interfund transfer out, and then it would be due to the debt service fund. So on May 28th, 2008, we're going to receive our first $3,000 so that we can go ahead and make this interest payment that's due on June 1. So we are going to receive, oh, by the way, the reason why we don't make any entries at the government-wide level, this is a budgetary entry, never at the government-wide level. And then this is us transferring money between two funds under the umbrella. So on May 28th, we're going to receive $3,000 from the general fund. So we were waiting on that. We were expecting it. So what we're going to do is we're going to receive cash. And it was $3,000. And we'll just do from general fund. So on June 1, we're going to go ahead and make the interest payment as scheduled. So now we're going to go ahead and do our expenditures. And we can identify that that's bond interest. 3,000. So I want you to notice that right now, our debt service fund cash balance now is 0. We brought in 3 and we spent 3. So if we were to do a balance sheet right now, like there's not a lot going on. All we would have is the fact that we have some estimated stuff that eventually will get close to each other. And right now we have a due from and we have our revenue. And so, yeah, not a lot going on right now. We have an expenditure that would get close to fund balance or whatever. So the government-wide level, instead of expenditures, we would do expenses and we would call that interest. All right, the remaining $8,000 is going to be received on November 29th. On December 1, we're going to go ahead and pay the interest and the principal that's due. So let's go ahead, and there's a lot of entries here, so let's do each one of them. So first, we're going to receive the $8,000 from general fund. So now the general fund has given us everything we're expecting. And then we're going to go ahead and make our interest payments, and we're going to go ahead and pay the principal as well. So we will do expenditures dash bond interest. And we'll also do expenditures dash bond principal. Now, you'll be tempted to use, to use like a bond payable account, but remember that we don't have a bond payable account at the fund level. So when we look at the government-wide entries, we'll see it there. Because remember, at the government-wide level, we established this serial bonds payable situation. So if you look at the government-wide level, we'll have expenses rather than expenditures, and then we'll have a payment on the principal. So we do need to do an adjusting entry on 12/31 because this all happened on 12. Well, this actually happened on 11/29, and then these entries happen on 12/1. So now 1 month has passed. So by the way, these entries are 12/1 and 1. And so on 12/31, we need to figure out how much interest do we owe. And so that we can do an interest accrual. Now I want you to notice that this is only at the government-wide level, because at the fund level, we're using the modified accrual basis. And so we don't actually record it as an expenditure until, or an appropriation until it's actually legally due. So here, I need to use I equals PRT. So let's use our formula. So I will equal, and so instead of 100,000, right now we only owe 95. And then it's 1 month, right? So 1 month out of 12. The 6% is an annual rate. It was 3% every 6 months. So we'll do 6% times 1/12. So 95,000 times 0.06 times 1 divided by 12, $475. And that will be interest expense and interest payable. So we'll do expenses dash interest and interest payable. So just like our adjusting entries that we do in intermediate accounting and financial accounting, we will use interest expense and interest payable. So on 12/31, we need to do some closing entries. So if we were to look back up with what we've got, we would need to reverse our budgetary entry, and then we need to close our revenues and expenditures. So remember that we're only closing at the fund level. So if I look back through everything, first I need to do a reversal of this. So I need to debit appropriations and credit estimated OFS. Okay. So I always abbreviate that. So this is closing the budgetary entry. And then if we look down through everything, due from general fund 11, we ended up receiving all of that. That's an asset, so it wouldn't get closed anyway, but I'm just curious kind of what we've got in the accounts. So due from general fund is all received. Goodness, there's a lot of door slamming, but I need to close this OFS interfund transfer in. So I'm going to go ahead and delete whatever's here so I can write it myself. So I'm going to debit OFS interfund transfer in, and then that would be 11,000. And so then to look and see what else we have going on, cash was received due from, okay, we have an expenditure of 3, and that cash came in and out. We have an expenditure of 3 more and expenditure of 5 more. So we have expenditures dash bond interest and expenditures dash bond principal. So this is 6 and this is 5. You would close things to fund balance, but we don't have any balances to close to because everything exactly offset. So it's such a clean, nice, pretty situation. If you were to do a balance sheet, it would have like nearly nothing in it. So maybe nothing at all, because we don't have a fund balance and we don't have any cash right now. So the balance sheet would be empty. There would be no assets and no liabilities and no equity. So it's so weird. Okay, but I like it. It's clean. So special assessment debt service funds. So this is dealing with some debt that goes to a specific group of people, not everybody. And so if the government isn't obligated to it, then it usually runs through an agency fund, because the agency fund just collects money and then turns it over to somebody else. And so we'll learn about that in chapter 8. So let's kind of look at this debt service fund. And we're only looking at the debt service fund entry on this. And so starting out, we have $1 million of special assessments were levied on property owners in a special benefit district, payable in 10 equal annual installments of $100,000 each. And so what we're going to do here, sorry, I thought we were going on to a term bond example, but what happened? Oh, I'm bad at this. Okay. All right. So what's going to happen here is we're going to go ahead and do, I think that I forgot to include the rest of these notes. So I'm going to have to re-upload the version to your, to Moodle. So I know that I'm doing this as we're speaking, but I'm going to go ahead for now. I love this funny. Okay, I'm going to hide this for a little bit while I figure out what I need to do differently, because I'm not seeing the entire bit of notes. And so I have chapter 6, student temporary. Okay, so I don't know where the rest of it is. Okay, so yeah, I have like this whole section on term bonds that's just not even showing up. And so let me pause my recording and I'll be right back. Okay, so I'm back to my recording. I went ahead and made them blank again. And so you guys will already have everything filled out up through page 4. And so we're ready to start page 5. And so page 5 starts with this term bond example. And so on this term bond example, what's happening with a term bond is that a term bond, instead of having several staggering due dates, it has one due date. So on January 1, 2007, $100,000 6% term bonds maturing on January 1, 2012, after 5 years, were issued. The first transfer to the sinking fund is to occur on December 31, 2007, and at the end of each of the following years until December 31st, 2011. Interest of $3,000 is due every 6 months on January 1 and July 1. Sinking fund investments are estimated to earn 7% annually. So as we deposit money into the sinking fund, it's going to earn interest. The general fund is going to give us money every year to make the interest payments and annually for the sinking fund investments. So we're only going to look at the sinking fund and trying to figure out what happens here. So if we pause a second and we look at what would happen is if you had to come up with $100,000 over a 5-year period, then your assumption would be that you would need to put 20,000 away each year. So 20,000 each year would then be 20,000 times 5, and it would be $100,000. But we will earn interest on our money while it's invested. So we have to keep that in mind. So what we're actually going to look at is what it would look like if, like, what would we need to put into an account so that if we deposited money at the end of every year for 5 years, and we're going to do it at the end of 07, 8, 9, 10, and 11, that by January 1, 2012, will we have enough money to pay off this? And so it says we're going to deposit money into our sinking fund annually. We need to compute. Obviously, we would think it'd be 20,000, but we're going to earn interest on interest. And so we're going to use the payment function. So you've learned this concept in intermediate 1, and we used it a lot in intermediate 2. If you had intermediate 2, you also would have learned it in principles of finance and maybe a little bit in financial accounting, depending on how far your instructor got. So I'm going to use the payment function. So in Excel, I'm going to hit the F of X button and I'm going to say payment. And the rate of interest that the sinking fund is going to earn is 7% interest. Now we're going to pay interest on our bond, and that has nothing to do with this payment. So we're calculating the amount of money we need to deposit every year. And if it's going to earn 7% interest, that's what we're going to consider. And we're going to do it for 5 years. And we want this account to grow to $100,000. So I'm going to put here negative 100,000 so that my answer is a positive number. So what it's suggesting is that we need to deposit 17,389.07 to get it to grow to 100,000. Now, just because sometimes students don't believe that, what I want to do is I want to kind of actually build and see what it would actually look like if we actually did that. And so considering that, if we look at each year, and we're going to put money in at the end of, so 12/31/07, 12/31/08, and we're going to do that until the end of 12/31/11. So we're going to make payment, we're going to make deposits into it. So we're going to deposit 17,389.07 into this account. And then it will earn interest. So we'll say estimated interest, but it's going to grow. It will earn interest. And so then what will be the balance? Now in the first year, we're not making that deposit until the last day of the year. So the interest is going to be 0. And so at the end of 07, it's going to be 17,389.07 because we're going to make that deposit on 12/31/07. So the balance on 12/31/07 is 17,389.07. But we're going to make that deposit every time. And so then we'll earn interest on the outstanding balance. So during 2008, we're going to earn 7% interest for the whole year. We won't earn interest on this 17,389 because deposited until 12/31/08. So the balance becomes 17,389 plus an additional 17,389 plus 12,1723. Then we'll earn interest on that balance. We made another deposit. And so then if I do this, and right now fat plus, arrow plus, skinny plus, double click. All right, so I want this to be prettier. So I'm gonna hit the comma button. And then we see that we'll have exactly $100,000 at the end of 2011. And then on 1/1/2012, we can repay this money. So this is the amount of the deposit I would need to make each time. I found that using the payment function. I use the F of X button so that I can see what all the different spots are. 7% interest, 5 years, future value. I want it to grow to $100,000. Okay, so in your notes, I went ahead and put a version of what I just did. So this version's prettier, I suppose, but these are the required additions. This is the money I would deposit each year. This is the earnings on it. And so it's going to go up by 17,389. This one, this, and the interest. So this is the new balance, additions, earnings, increase, new balance, interest, or I'm sorry, deposit, interest, increase, new balance. And so this is to help us to be able to plan. Now, we think we're going to make 7% interest, but things can go right or things can go wrong. We can earn more, we can earn less. And so, but this is at least making us deposit a good chunk of money every year in this bond sinking fund so that that money can then grow, and we'll be able to have enough money in there to be able to repay the bondholders when it's time. So the budgetary journal entry at the beginning of, so what year is this? This is 07. So on January 1, 07, we're going to make interest payments on January 1 and July 1. So we're only going to have to make one interest payment during 2007. So we'll only have to do 3,000 in interest, not 6,000. And then we're also going to plan on receiving that 17,389. So the budgetary entry of the year is going to be the 17,389 sinking fund edition, as well as 2. And so I thought it would only be 1. I thought it would only be 1. Okay, so they said that we're going to go ahead and accrue for the extra payment. Well, I guess I'm wrong. I would have thought we would just do 1 because we only make 1 during this time, but I guess it's due the next day. And so we'll probably be, well, I guess that makes sense. So we won't record it as an expenditure, but we will receive the money. So as far as doing like OFS and stuff, I don't know. So, so we're going to do estimated OFS. Oh, I thought I fixed this. Oh, there. A lot going on. Okay, there we go. Estimated OFS for, and so it's 17,389 plus 3,000 plus another 3,000, 23,389. But we're only going to actually spend $3,000. So it's interesting. And so we'll do fund balance here, because remember that we're only going to actually make 1 interest payment. So 23,389 is how much we'll expect our fund balance to go up for. So this is the budgetary entry. And then we're going to go ahead and do the due from and the OFS. Enter fund transfer in. Okay. All right, so let's go ahead and record entries, transfers during the year, and the payment of the July 1 interest. So we're going to receive some money on 6/30, and then we're going to turn around and pay out that interest, and then we're going to receive some more money on 12/31. So let's go ahead and do that. So first we're going to go ahead and receive cash, and we'll do due from general fund. And then we'll go ahead and make the payment. And so then we'll do expenditures dash bond interest and cash. So this is us receiving the transfer from the general fund on June 30th and then paying it on July 1. And then on 12/31, we're going to receive the other 23,389. And so when we get that cash, it'll be due from the general fund, and then we have to decide what we're going to do with that. Okay. So 3,000 of it is for interest for tomorrow. And the other 17,389 is to be invested so it can earn 7% interest. So let's invest the sinking fund addition. So we are going to debit investments, 17,389. And we'll remove that cash. And so this is us creating some kind of investment account. So I don't know if we deposit it, and it's not obviously not a savings account because savings accounts don't earn 7% interest, but we're investing it in whatever mutual funds or whatever we invest in. We don't decide. So 17,389 is invested so that it can begin growing at 7% interest into the bond sinking fund. So closing entries as of 12/31, we need to reverse our budgetary entry. So when we reverse our budgetary entry, we will debit appropriations. Sorry, I got to go back and look. Debit fund balance. Estimated revenue, it's estimated OFS. Okay, and then we also need to close our other temporary accounts. So let's look through and figure out what all we've got going on here. So we just closed this one, it's gone. Due from general fund, the 23,389, we received all that, right? due from and due from. Yep, all that's taken care of. So we need to close OFS, interfund transfer in. So that needs closed. Okay, so I'm just kind of looking for everything we have. So I reversed this already. That is equal to 0 right now. I just closed this. Okay, this cash, I turned around and spent it. But I do have an expenditure for bond interest. So expenditures, bond interest, I'm gonna skip a line. Okay, so I did that. Okay, this cash offset from this cash. So I have this 20,389 and I invested 17,389. So I think that my balances are investments of 17,389, cash of 3,000, and then fund balance of 20,389. So if we did a balance sheet, this is literally all we have. So our investments account has some money in it. We have some money because we're going to pay that tomorrow. And our fund balance right now is sitting at the total of assets. Total assets equals total liabilities and equity. So, all right. So in the second year, go ahead and do the second year exact same thing. And so I probably meant to leave that filled in for you. But for the second year, then what we're going to do is we're going to go ahead and do the exact same thing, basically. So we'll have estimated OFS. And so 23,300. Estimated revenue for investment earnings, because we think that 17,389 is going to earn some money. We think it's going to earn 1217.23. Okay, so we think it's going to earn 1217. As far as appropriations, we're going to have to spend 6,000, and the rest will go to fund balance. That is, but it's 23,389 and 1217. Oh man, 23,389 plus 1217. 24,606 minus 6,000, 18,606. Which the amount that it goes up by should be these two numbers added together. Yeah, 18,606, because we're going to receive this much that we're going to put into our investments account, and we're hoping that our investment account will also earn this much all by itself. So then we're going to go ahead and do the due from general fund, 23,389, OFS. And then on January 1, we'll go ahead and spend that 3,000 we had from last time. That would be cash. So now, if we considered our balances, like our cash account just went away, our cash balance is now 0. So this is record entries for the two transfers during the year and the payment of the July 1 interest. So we would receive cash, and it would be due from general fund, and then we would pay the interest. And then we would go ahead and receive the other cash, which would be 2389, I think. And then we would invest that into the sinking fund. Investments, 17,389. So now our investment account has the 17,389 from this year and next year. And we also need to look and see if the investment account earned any money. Investment earnings for the year of 2008 were 1517 compared to the budgeted amount of 1217, or 300 more than expected. So we actually made more than we planned on making, which is lovely. And so as far as the investments account, it went up by 1517. And we'll just call that, what did we, I was going to ask what we called it before, but That was the budgeted one. So for the budgeted one, we said we plan to earn, sorry, I keep losing myself, estimated revenue, investment earnings. Okay, so we can just call it investment earnings. So when we do our closing entry, for this, we need to close the budgetary account. And so we need to do the exact opposite of our budgetary thing above. And so we have appropriations as a debit of 6. We'd have fund balance, and I don't remember that number. And then we would have OFS, interfund. Oh, this would be called estimated OFS, interfund transfer. I don't think we had to do the dash. And that was the 23,389. And then we had estimated revenue dash investment earnings. So we thought it was only going to be 1217. And so that number, I don't want to go back and look, 23,389. Oh, hello. 23,3, hello. Okay. 23. Oh, okay. My caps lock wasn't on, or my num lock. 18,606. So this is an exact reversal of our budgetary entry that we did right here. Getting rid of estimated OFS and estimated revenue, getting rid of appropriations and fund balance. And then here I need to get rid of my OFS, interfund transfer in. And then I need to get rid of the expenditures dash bond interest. And that was 6,000. And then I need to get rid of the investment earnings. And that was 1517. And then the difference will go to fund balance. So I thought fund balance was going to go up by 18,606, but I think it's going to go up by 300 more than that. So 18,906. But I'm just going to check my numbers. 23,389 plus 1517 minus 6,000. 18,906. Uh-oh. Why are you being so weird? Oh, is there something there? Okay, sorry about that. There. Okay, so let's pretend we did the entries for 2009 and 2010 and pretend that investment income was the same as we planned in the amortization table. So basically, like, we're going to pretend that we did all those entries for 2009 and 2010, and we received exactly 2520, 3913 for those 2 years. So for year one, let's go ahead and do the debt service fund entries. So I'm kind of sad I deleted all of these. I wasn't sure how much I wanted to delete, but it's okay. So we would have estimated OFS 3,389. This is for the last year. We would have estimated revenue dash investment earnings if we want to do dash, but it would be for the investment earnings and plan on earning 5404. Our appropriation plan on being 6,000, and the difference will go to fund balance. $22,790. So on we'll do general fund 23,389, and then we'll do OFS interfund transfer in, and then we'll go ahead and pay our expenditures dash bond interest. We pay that on January 1 and July 1. Record entries for the 2 transfers during the year and the payment of the interest. All right, so we will get another, so we'll get cash of 3,000 due from general fund. And then we'll get, we'll go ahead and make the bond payment, expenditures dash bond interest. And then we'll get the rest of our cash, which will be 20,389. And that will be due from general fund. Okay, Then we will deposit the money into the sinking fund. And then let's say that our investment earnings are 5604 instead of the 5404. We planned on it being 5404, but let's get an extra $200. So we will deposit that into our investments account. And so, and then it'll be investment earnings. So then as far as the closing entry, we would reverse our budgetary entry from the previous page, close the interfund transfer in, close the investment earnings of 5604, close expenditures dash bond interest with a little more in fund balance. So on January 1, 2012, we need to do one final budgetary entry because we need to go ahead and make our final payment. So we are almost done. And so we're going to go ahead and we have to expend like $100,000 and so and $3,000 in interest. So as far as the budgetary entry goes, we need appropriations. Sorry, looks like there's still stuff under there. Okay. Appropriations. And so we need to pay the 100,000 and we also need to pay the 3,000 of interest that we have to pay on the last day, because that's tomorrow. So we are not bringing in any more money. So we have no estimated OFS coming in because we are literally just going to pay out the 103. So I need to know what the balance is in our investments account. And so I don't think there's anything in here, but I want to make sure. Okay, so what I need to do is I need to look at all the money that I deposited. So we can start with year one. We deposited 17,389. And then the next year, in year two, I think I have enough room to do this, 17,389. And then in year two, it earned interest of more than we planned. It was supposed to be 1217, but it was 1517. So in year three, it was 17,389 and it was exactly as planned. Exactly as planned was 2520. In year four, it was 17,389 and it was exactly as planned. So it was 3913. And then in year five, oh, sorry, that was a mistake. It was a 17,389 and then we earned more than we planned because we earned 5604. So I know it's kind of weird to write it like this, but it made the T account not have to be so tall. So, okay, so the investments account, because remember every time we earned interest, it got deposited directly into our investments account. So let's see what the balance is in investments. Yeah, 100, 499. Okay, let's just pretend that came out right. And it was 100, 500. So it's a rounding mistake. And so I can't handle that 499 right now. So we'll just pretend it's exactly right, that we rounded properly. So 100, 500. So first thing we need to do is we need to cash in our investment. So we need to close the investment account. So at that point, then we are going to receive cash of 100, 500 and close out our investments. So now we have basically the $3,000 from last time, and then we have this 100,500, right? So we need to make the final interest payment, and we need to go ahead and pay the bond interest from this time. So we will do expenditures dash bond interest for 3,000, and then we'll do expenditures dash bond principal 100,000. Now I know I have more than that, because my investment did a little better than I planned, but I don't have to give that to the bondholders. So that's 103. All right, and so then I need to do my closing entries. So when I do my closing entries, I've got to reverse my appropriation thing. So appropriations was 103. Fund balance was 103. And then I have these two expenditures I need to close. And that would get closed to fund balance. Okay, so at this point, we kind of need to figure out what we have left in the account. And so what I want to know is what's left in fund balance. And so basically, every time we did closing entries, we just reversed our budgetary entry, but then we had the fund balance account. So let's go back up to the very beginning. Oh, this was a big old problem. A lot going on in here. Okay, so this was the budgetary entry. So when we did our closing entries, we reversed it, but then we ended up putting 20,389. I don't know what that sound is. I don't even know where it's coming from. Oh, just one second. I'll pause my recording. Okay, it's been a distracting few minutes, hasn't it? Okay, so I am back. And so basically we started off and in the fund balance account, the first year was 20,389. And that's because we had an extra 3 in there to make an interest payment. So let's start with that. And so in year 1, we'll do 20,389. And in year 2, did we do the entries for year 2? I think we did. Yeah. So it was just 18,906, which was 17,389 plus 1517. So 18,906. Oh, by the way, I think I'm putting this on the wrong side. Okay, because fund balance is a credit. I do that, I swear. So 18,906 was year 2. And then the next year, we earned exactly what we planned. We didn't do the entries, but it would be the 17,389 and the 2520, which is 19,909. And the next year, we didn't do the entries, but it was exactly as planned. So it would go up by the 17,389 and 3913. So 21,302. And then in the last year, we did do the entries. This is year 2007. Yeah, I'll put that in because we actually have a 6th year to go with. Because we have year 2011 where we earned a little extra. And so 22,993. Because remember, we earned an extra $200. Isn't that what it said? An extra 200 more than we planned. Yeah. So it would be year 5's numbers, 22,794, but it was a little bit more. So instead of 22,794, it's 22,993. We could put 4 so we come out perfect. And then fund balance went down in that last year by 103. So this is 2012. And so now let's see what the balance is in this account. $500, which completely makes sense because that $500 is the extra money we have sitting in the account that is waiting to get paid out. So the $500 is the extra money that we earned more than we planned is what it is. Is we have to figure out what to do with it because we're done servicing the debt and we just have this extra $500. And so normally you go ahead and transfer that to the general fund. So you would go ahead and just give it to the general fund. And so, but when you do that, you have to do an OFS, like an OFU, interfund transfer out. So if we were to finish this out, we would do an OFU, interfund transfer out to get rid of the last $500. And then we would close OFU. Which would then get rid of the balance in fund balance. So our fund balance was a credit of 500. And now I'm debiting fund balance. And so then now the balance in fund balance is 0. And that extra cash I have is gone and everything is done. That was intense. So much fun. Thanks for letting me do. Be patient with me. So we have one last part to deal with, and it's special assessment debt service funds. And I don't think I'm going to have you guys do any homework on this, but I'll go ahead and run through it real quick anyway. Example, 1 million of special assessments were levied on property owners, payable in 10 annual installments of 100 each. Okay, so what we're going to do is we're going to do, oops, down here. So we are going to receive some money. We're going to receive 100,000 a year. And so some will be current. And the rest we will receive later. And so we're going to earn some of it as revenue. And the rest will be deferred revenue. So assume all assessment receivable current was collected in the year along with 8% of interest on the unpaid balance. So I equals PRT. So it would be 1 million times 8% for a whole year. So that would be what, $80,000 that we would earn on interest on that $1 million, because it said 8% somewhere, didn't it? Why did I just make up? Oh, yeah, here it is. I was like, where did that 8% come from? Okay, so we're going to go ahead and receive cash of 180,000. And that was the money we were waiting on. And that would be revenue. So the bond principal of 100,000 and the interest of 8% were paid on schedule. So then we would go ahead and pay this interest. So we receive it from the special assessment holders, and then we turn around and we pay it for someone else. So we're going to go ahead and do expenditures dash bond interest and expenditures dash bond principal, and pay off $100,000 of the debt. So 80,000 and 100,000. We'll pay out that cash. It's 180. Okay, and so at year end, we will reclassify some of the deferred to become current and some of the deferred revenue to become current. And then we would do the exact same entries again. The next year though, instead of the interest being 80,000, it would be 900,000 times 8%. So it'll only be 72. And then when we made the interest payments, it would only be 72, and we'd pay off another 100,000. And then we would do this exact entry to reclassify again and just go from there. So, all right. So debt service funds, I think they're pretty clean. I hope you enjoyed it. And so we're going to do a couple of homework problems on it. So let me go ahead and show you guys what your chapter 6 homework looks like. So you guys are just going to do multiple choice and then one problem. How beautiful is that? You guys earned it. So you'll have your multiple choice, and then you're going to do the journal entries for a serial debt service fund. And then you're going to do the T accounts, the balance sheet, which the balance sheet, look how little it is. All it has is cash, taxes, receivable, delinquent, and then total assets will equal fund balance, and it should balance at 529. And then a little baby income statement. And so the fund balance should be 529. So I didn't put a little arrow to this like I usually do, but that will be 529 because that's all we have in fund balance. So as far as revenues, you'll have some tax money coming in, and then you'll make your bond interest payments and your principal, and then your excess, and you'll have an interfund transfer in coming in as an OFS. You'll end at 529. So hopefully your homework is a lot lighter this time because you're finishing up your chapter 4 project. If you already have that done, I'm going to post your second project probably today so that you guys can start working on that if you're ready. So I hope you guys are doing well, and I'll talk to you later. Bye.